Hello everyone, hope you all are doing good. So we are back with one more revision video on AS3 cash flow statement. Okay, this chapter in your book will be in two places. One in module 3 under the chapter financial statements of companies, and again in module 1 under the under fourth chapter known as AS3 cash flow statement. While you can start with practicing the module 3 chapter, there are one or two important questions in the module 1 chapter as well, which I'll be discussing in today's class. So like how we have structured the previous revision sessions, here also we will first quickly revise the concepts and then we will discuss two or three important, very interesting questions in this standard. So let's get started. As you all know, cash flow statement is a statement. It's a part of the financial statements. It is a statement showing the reasons for changes between opening cash and cash equivalents and closing cash and cash equivalents. Basically, you're trying to tell the users at the beginning of the year, this is the cash and cash equivalents that I had. At the end of the year, this is the cash and cash equivalents I am having. Why there is a change, I am trying to explain through a statement. That statement is called as cash flow statement. It helps us in understanding the various sources of inflows of cash and outflows of cash. So the basic understanding in the standard will start with understanding the definition of cash and cash equivalent. What is the definition of cash and cash equivalent? AS3 says cash and cash equivalent has two components. One is cash and another one is cash equivalent. Cash includes both your cash in hand and the demand deposits with bank. Be very careful. Demand deposits means something that is deposited in the bank which you can withdraw whenever required. That is called as demand deposits. So cash component includes both the cash in hand as well as demand deposits with the bank. Then the second aspect of the definition, which is cash equivalent, this actually includes certain highly liquid short-term investments. Actually, this is not cash, this is an investment which is similar to cash or which is equivalent to cash. That is why it is called as cash equivalent. It is a highly liquid, something that is easily convertible into cash with a short maturity period. AS3 says generally a period of 3 months or less can be considered as short term, where the risk of change in value is very insignificant, very less risk of change in value. If a particular investment satisfies all these criteria, then it will be considered as a cash equivalent and it will be taken as a part of cash and cash equivalents. It should be highly liquid. It should be a short-term one. Short-term means 3 months with insignificant risk of change in value. This is something which you should understand while defining a cash equivalent. So if you take cash in hand, add demand deposits with the bank, add any other investments satisfying the definition of cash equivalent, the total becomes cash and cash equivalent. Generally, the best example of cash equivalent will be a fixed deposit which has a shorter maturity period of 3 months or less. So this is the definition of cash and cash equivalent. Now, when you are showing the reasons for change in cash and cash equivalents, why the opening was this much, why the closing is this much, when you show those reasons are categorized into 3 activities. Why the cash has changed, that reasons AS3 is categorizing into 3 activities. One is called as operating, investing and financing. The 3 activities in AS3 are operating activities, investing activities and financing activities. It is very, very important for a student to read the question and identify each item as to which activity it belongs to, whether it is an operating activity or an investing activity or a financing activity. You should be able to identify it correctly. Only then your cash flow statement will be accurate. Okay, first let us not define operating activities. Let us finish the definition of investing and financing, and then we will come to operating. Okay, very, very simple. Investing activity means either purchase. Okay, our institute will use the word acquisition, which is same as purchase. Either purchasing or acquisition and selling or disposal. Either you acquire or you dispose. What will we dispose or acquire, sir? Fixed assets or intangible assets, or you can acquire and dispose investments that are not included in the definition of cash equivalents. Remember, only those investments acquisition and those investments sale which are not included in the definition of cash and cash equivalents, only those will come under investing activities. If something is a part of cash equivalents, that cannot come as a part of investing activities. So very, very simple. Investing activities means acquisition or disposal of long-term assets. Those long-term assets will be PPE, intangible, and any other investment that are not included in the definition of cash equivalents. So when you purchase this or sell this, it will be a part of investing activities, and any income that you earn from these investments also will be a part of investing activity. Remember, purchasing a plant and machinery, selling a plant and machinery will come under investing activity, but selling the goods produced from that plant and machinery is not investing activity. That will come under operating activity. Ensure you have that clarity. Investments also, when you purchase investment, it is investing activity. When you sell investments, it is investing activity. Even any interest or dividend or any other income that you receive from these investments, even those fall under the definition of investing activities. So when you are reading the question, clearly identify those things that will fall under investing activities, which will mostly be your fixed assets, that is plant and machinery, vehicle, furniture, all those will come, land and building, plus your investments will come which are not there in the definition of cash equivalents, plus any income from these investments will also come under investing activities. Okay, hope I am clear with this investing activities definition. And then financing activities, AS3 defines financing activity. Keep it very simple like this. In your balance sheet on the liability side, you will have two sources of funding. One is your capital and another one is your borrowings. Any activity that changes this capital or that changes this borrowings, for example, you are issuing equity shares or you are issuing preference shares, this activity will change the capital. Or you are buying back your equity shares or you are redeeming the preference share capital, this will change your capital. Similarly, you are borrowing loan or you are repaying loan or you are issuing debentures or you are redeeming debentures. In all these cases also, borrowings will change. So any activity involving cash flow that brings about a change in the capital and borrowings, that will come under financing activity. Not only this, on the capital whatever you pay, which is your dividend, same way on the borrowings whatever you pay, which is interest, that also will come as a part of financing activities. I hope you are very clear with this, sir. That means investing activity takes care of fixed assets, intangibles and investments. This financing activity takes care of capital and borrowings and even interest payable on that. Operating activities, remember, something that doesn't fall under investing and financing is operating. It is the cash flows from your core operation, or in other words, cash flows from principal revenue producing activities. That is your basic business activity. Business irukkarade adukagada. In English, your business is existing itself for that. From those activities, whatever cash is getting generated or whatever cash you pay, that comes under operating activities or operating cash flows. So all your cash flows needs to be distinguished in these three categories. One is operating activity, another one is investing activity, and third one is financing activity. This categorization is very, very important. Without this proper categorization, you will not get full marks in the exam. Let us quickly see certain examples and identify whether it is operating or investing. See, if we know operating, investing, and we are very thorough with cash flow statement format, we understand the logics for both direct method, indirect method, then you should be able to easily solve the sums. Okay, so let us quickly revise. The first column I have given the type of transaction, and in the second column what will be the classification for a financial enterprise and what will be the classification for a non-financial enterprise. That is what we are mainly going to see. By financial enterprise I mean banks, NBFCs, where their core business itself is to borrow money and lend money. Okay, non-financial enterprise are our trading businesses, manufacturing businesses, or other service businesses not involving in financial services. Those come under non-financial enterprises. Let us see each one. Loans and advances given and interest earned on them. For a financial enterprise, that is a part of their core operations that comes under operating cash flow. But for a non-financial enterprise, loan given is not a core operation. It is like an investment made. So that comes under investing activities. Same way, loan and advances given to subsidiaries. This is not for public. You are giving to subsidiaries. That is an investing activity both for financial enterprises as well as non-financial enterprises. Loans and advances given to employees and interest earned on them is an operating cash flow for both the enterprises. Remember, any transaction with employees will be operating activity. Okay, don't forget this. Any cash flow involving employees will be an operating activity. Advance payments to suppliers and interest earned on them. Obviously, suppliers means something as a part of your business. So that will be operating cash flow for both financial and non-financial enterprises. Interest earned from customers on loan late payments. Customers are paying late. You're asking for interest. Customers are somebody who come as a part of your core business. So that will be operating cash flow both for financial and non-financial enterprises. Deposits taken for public, for a financial enterprise, that is their core activity. So for them it is operating cash flow. But for non-financial enterprise, deposit is like a borrowing. So for them it will be a part of financing cash flows. Loan borrowed for a financial enterprise also it will be a financing cash flow. For a non-financial enterprise also it will be a financing cash flow. It will be a financing cash flow. Just a minute. So loan borrowed will be a financing cash flow for both financial and non-financial enterprises. Interest paid on loans, obviously. Now for financial enterprises, whatever deposits they borrow, that is a part of their operating activities. So any interest paid on that will also be a part of operating activities. For non-financial enterprises, borrowing deposits or borrowing loans is a part of financing activity. So any interest paid on them is also a financing activity. Advance taken from customers and interest paid on them. The moment you see customers, the moment you see suppliers, the moment you see employees, your mind should say it is a part of operating activities. Interest payment to suppliers, I told you just now, the moment you see suppliers it will be an operating cash flow. Interest capitalized in inventory. See, generally financial enterprises will not have inventory because they are banks, so for them this will not be a part. So interest capitalized in inventory, since inventory is a part of operations, so whatever interest that you capitalize in inventories, if it is a qualifying asset, that will be an operating cash flow. Investments made and dividend or interest earned on them if a financing enterprise regularly deals with them. So an enterprise regularly invests and regularly earns dividend or income. So for them it will be an operating cash flow. For non-financial enterprises, their regular business will not be to invest. So whatever investments they do, whatever income they earn from those investments, that come as a part of investing cash flow. Long-term investments made and interest or dividend received on them. So when you make long-term investments, those will be a part of investing cash flow for both financial and non-financial enterprises. Investment made in subsidiaries and dividend earned on them will be an investing cash flow both for financial and non-financial enterprise. Now this is very important. Remember, dividend payment is a financing cash flow for both financial and non-financial enterprises. Sir, what about taxes? Taxes, remember, if taxes are relating to operating incomes, it will be operating cash flow. If they are relating to investing activity incomes, they will be investing cash flows. If they are relating to financing activities, then they'll be a part of financing cash flows. So based on which activity is giving rise to tax, you have to classify the tax payment accordingly. If an operating activity is giving rise to tax, the tax will be a part of operating cash flow. If an investing activity is giving rise to tax, the tax cash flow will be a part of investing cash flow. If financing activity is giving rise to tax, the tax cash flow will be a part of financing cash flows. Then any insurance claims that you have received from loss of stock or loss of profits, it is an operating cash flow for both financial and non-financial enterprises. But one thing, this loss by fire is not something that will happen regularly. So it is an extraordinary item. Remember, it is an extraordinary item which needs to be separately disclosed in the cash flow statement. Insurance claims received against loss of fixed asset. Previously it was loss of inventory, so it was operating cash flow. Now it is loss of fixed asset, so it should be a part of investing cash flow. Again, this loss will not happen every year, so it is an extraordinary investing cash flow. And profit on sale or disposal of fixed assets, then this is not at all a cash flow. Remember, for something to be a cash flow, cash or bank should be a part of the journal entry. The journal entry for profit on sale of fixed assets is fixed assets account debit to P&L. So in this there is no cash involved at all. So you cannot call this as a cash flow. It should be removed under non-cash items, which we'll be seeing later. Purchase or sale of machinery or long-term assets is always an investing cash flow. Proceeds from issue of share capital is always a financing cash flow. Cash sales, obviously it is an operating cash flow. Proceeds from or repayment of borrowings or debentures or loan is a financing cash flow. Checks collected or cash receipts from your customers will be an operating cash flow. Trade commission or royalty received, this is a part of operations, so it will be an operating cash flow. Purchase of investment or sale of investments which are not included in cash equivalents, that will be an investing cash flow. Redemption of preference or equity share capital will always be a financing cash flow. Cash purchases or cash paid to trade payables, which is a suppliers, obviously that will be a part of operating cash flow. Purchase of goodwill at the time of amalgamation itself is an investing cash flow, so purchase of goodwill will also be a part of investing cash flow. Wages and salaries paid, it is a part of your operations, so it will be an operating cash flow. Office and admin expenses or manufacturing overheads or selling and distribution expenses or rent paid will be a part of operating cash flow, because all these expenses are incurred as a part of your operations. Rent received on property held as investment, so this is an investing activity, this is an investing cash flow. Underwriting commission paid, underwriting commission is generally with respect to financing activities, so this should be a part of financing cash flow. Underwriting commission relates to raising of share capital, so raising of share capital will come as a part of financing activity, so this underwriting commission should also come as a part of financing activity. Remember, don't think it is very long, it is covering almost all the adjustments given in all the ICA questions, that is why it's quite long. So once you're very thorough with that, most of the ICA questions you should be able to identify which is operating, which is investing, and which is financing. That guarantee I can give it to you. Brokerage paid on purchase of investments. Purchase of investments itself is investing cash flow. So any brokerage that you pay on that will also be a part of investing cash flow. Bank overdraft or cash credit will be a part of financing cash flow because these are loans. Investment in or redemption of short-term deposits which are not included in cash equivalents. Remember, if any investment which is not included in cash equivalent itself, if it is shown separately in balance sheet, not given under cash equivalent, then automatically your mind should say it is a part of investing activities. Okay. Refund of income tax received, if nothing is given, we will assume that income tax relates to operating activities, so we will show it as an inflow under operating cash flows. Receipt of grant for capital projects. Capital projects here means projects relating to purchase of PPE, that should come as a part of investing cash flows. Income tax paid, if nothing is given, we will take it as a part of operating cash flow. But if we know it is because of which activity, then the classification will be based on the classification of that activity which is giving rise to this tax. Tax paid on capital gains. We all know capital gains arises from sale of fixed assets and investments which are actually part of investing activities. So tax paid on that also will be a part of investing activities. Capital advances paid. Sir, what is a capital advance? Capital advance means advance paid for the purchase, for advance paid for purchase of fixed assets. So purchase of fixed assets is a part of investing cash flow. So capital advances are also a part of investing cash flow. Payment to capital creditors, not trade creditors. Capital creditors are creditors in respect of fixed assets. So whatever relates to fixed assets, that should come as a part of investing cash flow. Operating lease, whatever you pay rentals under operating lease, that will be a part of operating cash flow. Whatever you pay under finance lease, since finance lease liability is treated as a part of borrowings, whatever you pay under finance lease will come as a part of financing activities. So whatever you pay under operating lease will be a part of operating activities. Whatever you pay under finance lease will be a part of financing activities. Please ensure you go through these. So once you are thorough with all these items, you should be able to answer all the questions in terms of the activities classification that is given in your book. Okay. Now let us see how to prepare a cash flow statement. Let us quickly revise this format. Then I will do one book question in here. There is one interesting book back question. We will discuss that. Okay. So first thing, I am first discussing on indirect method. Guys, remember this indirect method or direct method is only for operating activities. Investing and financing are always under direct method only. When somebody says direct indirect method, the direct indirect method will only affect operating activities. Investing and financing are always under direct method. For investing and financing, there is nothing called indirect method. So have this clarity. Now, indirect method, how to prepare a cash flow statement. Okay. First thing, please, you should be very clear on what is your starting point. This starting point should be very clear for you, because sometimes in the question, see how the generally a question on cash flow statement will be there is, they will give you a balance sheet, they will give you additional information, and they will ask you to prepare a cash flow statement. Sometimes they will give you balance sheet, P&L, additional information, and cash flow statement. This is somewhat similar to what you would have seen in your foundation also, where in a chapter called non-profit organization, they will give you balance sheet, they will give you income and expenditure, they will ask you to prepare receipts and payments account. Here also similar way of questions will be asked, but here you should call it not as receipts and payments, you should call it as cash flow statement. So first point, when a balance sheet is given, immediately go to reserves. In reserves, there will be something called as P&L. This is actually P&L personal account. Okay. This P&L which is there as a part of reserves represents accumulated profits. It is not 1 year profit. It is cumulative profit. For example, in a balance sheet under reserves, if you see, I'm sorry, 1 minute. under balance sheet, in reserves, if you see P&L of assume 100 rupees, and this is balance sheet as at 31st March 2026. Now when you see 100, don't think this is 100 is 1 year profit. That is a very, very wrong understanding. Whatever P&L is there in balance sheet is cumulative profit, or in other words, it is accumulated profit. It is the profit that has been accumulated since the start of this business till 31st March 2026. I'm sorry. This 100 means profit that has been accumulated and not distributed to the owners from the start of the business till 31st March. Remember, P&L that is there in the balance sheet is not single year profit, it is accumulated profit. Okay, so for you balance sheet will be given. In that balance sheet, go to reserves. In reserves, there will be something called as, just a minute. In reserves, there will be something called as P&L. That P&L represents accumulated profits. They will give you both closing balance as well as opening balance. You will be given current year closing, last year closing also. Last year closing is nothing but opening balance. Take the difference of closing balance minus opening balance. P&L closing minus P&L opening. Okay, P&L in the balance sheet. Don't go and search in normal P&L account. Normal P&L account that you prepare is nominal P&L that gives you 1 year profit. But whatever balance sheet is there, in that whatever P&L is there, that is a P&L personal account which is accumulated undistributed profits. So take the closing balance of that P&L and from that subtract opening balance. What you get will be net profit after tax after appropriations. Net profit after tax and after appropriations. Have this point very, very strong in your mind. The difference between P&L personal account closing balance and P&L personal account opening balance is profit after tax and after appropriations. Now what you have to do? First, you have to reverse all the appropriations. The best examples of appropriation is your reserve creation. Assume you have created general reserve. The journal entry will be P&L account debit to general reserve. This is obviously a non-cash item where there is cash in the journal entry. So first thing, you have to reverse these appropriations. So if there is transfer to some other reserve, add that. If there is transfer from some other reserve to P&L, subtract that. This is one appropriation. Another appropriation is dividend. So dividend is always an appropriation. Remember, both equity dividend as well as preference dividend, both are appropriations that cannot go to P&L nominal. It should directly be recorded in P&L personal. So whatever dividend is declared that is there inside this P&L personal, that also you add it back. Now once you reverse all these appropriations, what you get will be profit after tax, but before appropriations, because all the appropriations have now been reversed. Remember, what you have to add is not dividend paid, dividend declared. In the class also we would have discussed this. When you prepare dividend payable ledger account, you will have two things. One is dividend declared, another one is dividend paid. What will affect your P&L is dividend declared. So what you have to add here is dividend declared. Then once you get profit after tax, whatever tax expense is there, add that back. Sir, I don't have tax expense, but I have a refund. Then subtract that. So this will remove the tax also. After doing this, what you get is profit before tax. If there is any interim dividend that you have paid also, remove that. That is also an appropriation. That also needs to be removed. Remember, Basically, first what I am doing, I am removing all the appropriations and I am removing all the tax related items. Okay, remember sir, how to know which is plus, which is minus? If something is debited in P&L, to remove that we have to add, because if something is debited, that will reduce your P&L. So to remove the effect of that, we have to add. If something is credited in P&L, it will increase your P&L. To remove the effect of that, you have to subtract. Okay, have this very strong in your mind. I'm repeating for you only. If something is debited to P&L and you want to remove that, you have to add. If something is credited in P&L and you want to remove that, you have to subtract. Okay, so now we have removed all the reserves, dividend, taxes, and if there are any extraordinary items like loss by fire, those extraordinary items, if they are expenses, they would have been debited to P&L. Add those and remove that. And if they are credited to P&L, subtract those and remove that. Once you do, okay, sorry, there is one small printing mistake here. I will get it changed in what I upload to you. This will be net profit before tax. Finally, you have removed tax, you have removed appropriations, you have removed extraordinary items also. So now what is left will be net profit before tax, before appropriations, and before extraordinary items. So please ensure that from the starting point of net profit after tax, after appropriations, and after extraordinary items, you remove all these three. Remove tax, remove appropriations, remove extraordinary items. Sir, how to remember add or less? Very simple. If something is debited in P&L, to remove that, add. If something is credited in P&L, to remove that, subtract. Then you will get net profit before tax, before appropriations, and extraordinary items. Okay, please be very clear on what is your starting point. Sometimes in the question he will give you this itself as a starting point. He will ask you to take this itself and start. That is, by this what do you mean, sir? Net profit before tax itself will be given to you. Then that time you should not do all these adjustments, because what is given to you itself is this one. So directly do below that. Please, in cash flow statement question, while you are reading, be very clear about what is your starting point. If they have not given and you are calculating by taking the difference of P&L personal closing balance and opening balance, then this is your starting point. Do all this. But if they are itself giving you what is net profit before tax, before appropriations, then this is your starting point. Again, you should not do all this. It will become double counting. So then take whatever is there below that. So now we have net profit before tax, before appropriations. Next, what we should do, sir? Isn't this cash flow? Not at all. Okay. Now to this, what we have to do? Inside this profit, we have certain non-cash items like depreciation. So depreciation is a non-cash. Yes, depreciation account debit to asset account. Where is cash in the journal entry? Amortization, revaluation loss, impairment loss, any fictitious assets written off like discount on issue of debentures, underwriting commission, and any loss on sale of fixed assets and investments. All these non-cash items will be debited to P&L. That should be removed by adding it. And similarly, if there are any non-cash items that are credited to P&L like profit on sale of fixed assets and investments, that also should be removed. Since it is credited to P&L, we have to subtract. So now we have removed non-cash also. Sir, that's all, sir. Non-cash removed. Now it is cash flow, sir. Not at all. Okay. Next, what will happen? Inside your P&L profit, you will have incomes and expenses relating to investing and financing also. For example, inside your profit, interest expense will be there that you have paid on loan. Interest expense paid on loan, is it operating or financing? It is financing, but it is there inside profit. So that should be eliminated, because what you are calculating here is cash flow from operating activities. So next step, what you have to do, identify all the expenses and incomes which are there inside the profit and which relate to investing activity and financing activity, and remove them. Remember, to confuse you sometimes what ICA will do, ICA will give both interest expense as well as interest paid. Now think and tell me, okay, this is very, very fundamental. Foundation itself you should know. Before foundation itself you should know ideally. Inside P&L, interest paid will be there or interest expense will be there. Think for a minute, no problem. All this is important. Okay. If somebody says interest paid, please revisit your fundamentals. They are very bad. That is the fact. Okay. What is there inside your P&L will be interest expense. So what you have to add back or remove under operating activities is interest expense, not interest paid. There is one question in your ICS study material itself where he will confuse you by giving both interest expense and interest paid. Many students have come to me asking, sir, why is interest paid not taken? Why they are taking interest expense while removing in operating activities? Array, in operating activities, your starting point is profit. Inside profit, what is included? Interest expense or interest paid? Interest expense. So how can you remove interest paid? What you have to remove is interest expense. So whatever expense that is relating to investing and financing activity that is debited to P&L, we have to remove that. So we have to add that. Similarly, any income relating to investing and financing activity that is credited to P&L, we don't need that because we are finding out operating activities ka cash flow. So that needs to be removed. So to remove those incomes, we have to subtract. Okay. If you do all this, still you won't get cash flow. Still what you have got is operating profit. Sir, why is it now called operating profit? Because everything relating to investing and everything relating to financing has been removed. That is why now it is called as operating profit before working capital changes. Now you have to do working capital changes. Sir, what we should do? First take current assets. Okay. Current assets, opening and closing balance both will be available. Add your opening balance, subtract the closing balance. Okay, now this is a revision video. I cannot discuss the logic of all this. We would have discussed this logic in the regular class itself. So here I'm just summarizing to you. So take the current assets, add opening balance of those current assets and subtract the closing balance of the current assets. Be careful when you are taking current assets. Daivame, don't take cash and cash equivalents. Please don't take cash and cash equivalents. Don't take advance tax. Don't take TDS receivable, and don't take any assets which are relating to investing and financing activities like interest receivable, dividend receivable, current investments. All these should not be taken. Please ensure you go through this list properly. If you do it wrong, your cash flow will not tally. So ensure that these assets you won't take it as a part of working capital changes. Then once you're done with current assets, go to our current liabilities. For current liabilities, it is opposite. Add closing balance of current liabilities and subtract opening balance of current liabilities. While taking current liabilities also, don't take bank overdraft, don't take tax related liabilities, and don't take any other liability relating to investing and financing activities like dividend payable, interest payable, etc. Okay, so ensure that these current liabilities are excluded. Okay, so these current liabilities, they should be excluded. They should not be considered as a part of working capital changes. So remember, for current assets, for current assets, you have to ensure that current assets or a closing balance is current assets or opening balance is added, closing balance is subtracted. Same way for same way for current liabilities, closing balance will be added, opening balance will be subtracted. Ensure you go through these things. I have clearly mentioned what and all should not be considered because those are common mistakes which students do in the exam. once you do all this, what you get is your cash flow from operations before tax and before extraordinary items. Now, whatever tax you have paid should be subtracted. No, sir, I have not paid tax, but I have received refund. That should be added because it is a cash inflow. And then any extraordinary cash outflows are there, that should be subtracted. Any extraordinary cash inflows are there, that needs to be added. Finally, once you do all this, you will get cash flow from operations. This is a part slightly tedious in the standard. This is what makes this chapter interesting also, and also tough in the exams. Remember, starting point is very important. So please be clear as to what is your starting point. Sometimes in the question, they will say, they will just give you net profit. Sir, now in ICA question, if they just say net profit, what is this, sir? Remember, if they just say net profit, this net profit is profit after tax, but before appropriations. Okay, please ensure you are careful about this. If ICA just says net profit, they have not mentioned what it is, this, sir. Their assumption is profit after tax but before appropriations. This understanding is very, very important, because if they just give net profit, that means it is before appropriations. Appropriations are not there, so you should not again do all these reserves and dividend related adjustments. If you do again, it will become double counting. Your answer will not match. That is why I am telling it is very, very important to be sensible and understand your starting point. Only if your starting point is net profit after tax and after appropriations, then you do all these appropriations adjustments. But what is given to you in the question itself is net profit before appropriations, then you need not do all these adjustments. Please have that clarity in your mind. Okay, that is very, very important. Next we come to investing activities. Investing activities. Okay, investing activities: sale of fixed assets for cash, sale of intangible assets for cash, whatever investments you have sold. This also will not be given to you directly. We have discussed in class also. You have to open fixed asset ledger accounts using the information that they have given. You have to find out. Okay, if it is given to you directly in the question, then I don't think such questions are worth at least just 6-7 marks. Mostly it will not be given to you directly. They will give you opening balance of fixed asset, they will give you closing balance of fixed asset, they will give you certain additional information. Based on that information, you have to open the ledger account and find out the sale or purchase as balancing figure. So if you have sold any tangible fixed assets, if you have sold any intangible fixed assets, if you have sold any investments for cash, these will be inflows. And if you have received any repayment of loans and advances that you have given, that also will be an inflow which will be added. And next, all we have certain outflows. Whatever tangible assets you have purchased should be subtracted, whatever intangible assets you have purchased should be subtracted, whatever investments you have purchased should be subtracted. And if you have given any loans and advances, it is an outflow, that also should be subtracted. Remember, inflows will be added, outflows will be subtracted. And any interest you have received on investments, remember, you should not take here interest income, you should take interest received, not interest income. You should take interest received. We have discussed this in class also many times. Income for the current year is equal to cash received plus outstanding end minus outstanding beginning plus advance beginning minus advance end. Use that formula. Find out how much is interest received. They will give you interest income, they will give you outstanding beginning, outstanding end, they will give you advance beginning, advance end. Using the formula that I discussed now, find out what is interest received. That interest received will be taken as a part of cash flow from investing activities. Any dividend received also will come here. Rental income received will also come here. Receipt of grants for capital projects, ensure you remember this. This is there in one of the ICI study material questions. Finally, what you do will give you cash flow from investing activities. Now our last thing, cash flow from financing activities. In financing activities, whatever equity shares that you have issued, including premium. Okay, including premium your day, because that is the cash received. It should be including premium after subtracting discount. Okay, so discount should be subtracted. If there is any discount, subtract discount, because to that extent you would not have received cash. If there is any premium, add that, because that is also a cash receipt. Issue of preference shares for cash including premium, that is also an inflow. Issue of debentures for cash including premium, that is also an inflow. Okay, see, generally shares cannot be issued for discount, but if there is any discount, take that, otherwise don't take. And any loans borrowed, that is an inflow, take it. Increase in bank overdraft, which is equivalent to loan borrowed, so take that also. Any grant that you have received in the nature of promoter's contribution, you would have learned this in AS12, take that also. Buyback of equity shares including whatever premium you pay on redemption, that is an outflow, take that. Redemption of preference shares including premium redemption, that is also an outflow. Redemption of debentures including premium redemption, that is also an outflow under financing activities. Any loan that you have repaid, take it under financing activity. Decrease in bank overdraft means you have paid that bank overdraft, so it is similar to loan repaid. And any dividend you have paid, be it interim dividend or be it final dividend, here you should take dividend paid, not dividend declared. What you take in operating activities under appropriations is dividend declared. What you take here is dividend paid. And any preference dividend paid, that also you subtract. Interest paid should be subtracted, not interest expense. If you subtract here interest expense, that is wrong. What you have to subtract here is interest paid. Sir, how will I find out? Again, same formula. Expense for the current year is equal to amount paid during the year plus outstanding end minus outstanding beginning plus prepaid beginning minus prepaid end. All this information will be given to you. Expense information will be given to you. Outstanding beginning end will be given to you. Prepaid beginning end will be given to you. Using the formula, find out the amount paid and take here interest paid. Remember guys, what you take here is interest paid. But in operating activities, what you adjust under indirect method is interest expense. Please remember this, ensure you're very clear on this, because what is included in profit is interest expense, but interest paid is your actual cash flow. So here you should take interest paid. And any underwriting commission paid should be taken, and any other expenses relating to issue of shares also should be taken. Those should be subtracted because they are outflows. Once you do all this, you will get cash flow from financing activities, and then add all these: cash flow from financing, cash flow from investing, cash flow from investing, and cash flow from operating. Add all this. Add all this. This, what you add, will give you the net increase or decrease in cash equivalents. To that, if you add the opening balance of cash and cash equivalents, you will get perfectly closing balance of cash and cash equivalents, and your CFS, cash flow statement, will tally. Okay, I hope you are clear with these. Okay, this is the indirect method operating activities format. Investing and financing, there is nothing called indirect method, it's always direct method. Okay, shall we go to one or two sums before we get into this direct method? Let us do one or two sums. Just give me a minute. This is an interesting question. Let us solve this question. There are only 3 questions which I mainly wanted to solve. So, okay. The balance sheet of New Light Limited as at 31st March 20x1 and 20x0 for the years ended are as follows. So, remember guys, one thing I want you to see it very carefully is this date column, see that perfectly, because if you see that wrongly or in an opposite way, your entire answer will go in reverse. I don't think IC will award you any marks. So please see this date properly. So this is previous year, which is opening. This is current year, which is closing. Ensure you first see that correctly. Then we have share capital, which will ideally relate to financing cash flow. Reserves, we need to see what is the breakup of reserves given in notes to accounts. So we have our P&L personal account and we have a general reserve. Both of these will come as a part of our operating activities under indirect method. So this is relating to operating cash flows. Long-term borrowings, it is a loan taken, so this will be a part of financing cash flow. Other current liabilities, don't just conclude, see what is there. Other current liabilities, we have dividend payable. So dividend payable is a part of financing cash flows. And then current liabilities is there. Current liabilities, if nothing is given, we'll assume it is relating to operating activities, since he has not mentioned what is the nature of those liabilities. Next, we have provision for tax. Since nothing specific is given, this will relate to operating activities. Then we have under assets, property, plant and equipment. This will relate to investing cash flows. Non-current investments will also relate to investing cash flows. Cash and cash equivalents, please don't take any difference of this cash and cash equivalents. It should not be taken. And other current assets, nothing is given. They have not given any breakup in the question itself. If nothing is given for other current assets also, we will assume it as relating to operations, operating cash flows. Now let us see what is given. Okay, we have both equity share capital as well as preference share capital. Anyways, both will relate to financing cash flows only. And we have debentures, which relates to financing cash flows. So if you see, I am reading each and every line item and trying to mark what it relates to. So this is also relating to investing cash flow. Now let us read the adjustments. The company sold one PPE, property, plant and equipment, for rupees 1 lakh. So this is an inflow. The cost of which was 2 lakhs. Original cost is 2 lakhs. Depreciation provided on that was 80,000. That means cost 2 lakhs. Accumulated depreciation for that asset is minus 80,000. So the book value will be 1.2 lakhs. So an asset having a book value of 1.2 lakhs, you sold it for 1 lakh. That means there is a loss on sale of 20,000. Ensure first you calculate this properly. Then what you have to do, immediately open PP ledger account at original cost as well as accumulated depreciation. I will show the ledger account to you. So if you see PP ledger account, first is our opening balance, which will be available in the balance sheet. Then closing balance also will be available in the balance sheet. Take those and write to balance brought down, by balance carried out. Then they sold the assets. So buyback, sale of assets, 1 lakh. Then whatever accumulated depreciation is there, that will be transferred from your accumulated depreciation account to PPE account. So here it will be by accumulated depreciation. And we also calculated loss on sale of 20,000. Loss on sale journal entry is P&L account debit to PPE account. So by loss on sale. Okay. And then there is one more adjustment. Let us read that in the question once, relating to PPE. The company also decided to write off another item of PPE, costing. That means this is the original cost before subtracting depreciation, on which depreciation was 40,000. That means original cost is 56. Accumulated depreciation that was charged on that is 40. So 16,000, an asset having a book value of 16,000 was written off. We didn't get any scrap value. So this entire 16,000 will become loss on sale. Okay. So let me show it. And they're also telling that depreciation provided on PPE is 3,60,000. So, and with respect to whatever asset we have written off also, even the accumulated depreciation on that asset will be sitting inside our accumulated depreciation account that needs to be closed and transferred to our plant and machinery ledger account. And then whatever is loss on write off, that also should be taken as by P&L. And now if you balance this ledger account, you will get a balancing figure of 8,56,000, which is the amount paid on purchase of PPE. This will come as a outflow under investing activities. It is mandatory that you show this ledger account in the exam. You cannot just like that calculate something from air. So you have to show this ledger account and then show this calculation. And then one more ledger account that they have opened is accumulated depreciation account. Opening balance will be given to you in the question. Closing balance also will be given to you in question. And then whatever depreciation charged also was given. So by depreciation, which is P&L, and these two, this relates to sold asset which will get transferred to PPE account, and this relates to the asset that was written off. This also should be transferred to PPE account. Okay, so prepare these two ledger accounts. Ensure from this ledger account whatever balancing figure comes, that is appropriately considered in cash flow. Now let us see the remaining adjustments once. Company sold some investments at a profit of 40,000. They have not told what is the amount of investments that they have sold. So let us see. If you see non-current investment, opening balance is 4 lakhs. Closing balance is 3,20,000. What you should do, open investments ledger account. Okay, open investments ledger account. Opening balance will be 2 balance brought down. I'm just writing in rough. Ensure write properly in the exam. 4 lakhs. Buy balance carry down 3.2 lakhs. And they also told you in the question that some investments were sold at a profit of 40,000. Profit on sale of investments, journal entries, investments account debit to P&L. So to P&L 40,000. There is no other information. So now if we balance this ledger account, the total will be 4.4 lakhs. And here also I'll put the same total of 4.4 lakhs. There is a balance of 1.2 lakhs, which is the sale proceeds on sale of investments. So this is an investing cash flow. This is an inflow which will be shown under investing activities. Ensure you also prepare this ledger account. They would have also prepared in the working notes. See here they have prepared same thing. 2 balance brought down, opening balance, closing balance. This is the profit on sale and this is your sale proceeds of investments. This should go to cash flow investing activities. And remember guys, this will be included in profit, but it is a non-cash item which needs to be eliminated in operating cash flows. Same way, this loss on sale of PPE, this loss on sale of PPE and loss on write-off also, both of them will be included in P&L. So we have to eliminate this while calculating cash flow from operations. Okay, ensure you are clear with this. Okay, now let's start on with cash flow. Okay, first if you see, they have given to me P&L personal. Opening balance, guys, first column is opening balance. We have seen the dates above. Opening balance 2,40,000, closing balance 3,40,000. Oh, sorry. Before that, there are two more adjustments. Sorry. Debentures and preference share capital redeemed at 5% premium. Debentures were redeemed at the year end. This is important. Redemption of debentures happened at year end. That means whatever debentures you have redeemed, to them also you have to give interest. Okay, remember that. If you see, debentures opening balance was 4 lakhs. Closing balance was 2,80,000. This amounts represent face value, not premium. Okay, So you have 4 lakhs and in closing you had only 2 lakh 80. That means debentures having a face value of 1 lakh 20 were redeemed. Were they redeemed at face value? No, they were redeemed at 5% premium. So what is the total amount that I would have paid, sir? 1 lakh 20 is the face value. On this 5% premium extra I would have paid. So 1 lakh 20,000 plus 5%, the amount that you would have paid will be 1 lakh 26,000. So ensure you are clear with this. Same way for preference share capital also. Preference share capital, opening 4 lakhs, closing 2 lakh 80. So that means you have redeemed preference share capital having a face value of 1 lakh 20. To this also you paid 5% premium. So total outflow under financing cash flows is 1 lakh 26,000. Guys, remember, not only this 5% premium that you have paid both on redemption of preference shares as well as debentures, this they would have debited to P&L. So it is a non-cash item. It is a non-cash item that needs to be eliminated. While preparing operating cash flows. Okay, be clear with these adjustments. The last one, the main reason why I'm doing this sum itself. Okay, company decided to value inventory at cost, whereas previously the practice was to value the inventory at cost less 10%. The inventory according to books as on 31st March 20x0, that means this is opening, was 2,16,000. The inventory as on 31st March 20x1, this is closing, was correctly valued at 3 lakhs. See, what was happening is, till the last year, the company was, for inventory valuation, they were doing at cost minus 10%. But current year, they changed their policy and they are planning to value the inventory at cost itself. So remember guys, this is change in accounting policy. Sir, sir, rectangle you have drawn some rectangle, sorry, you have drawn some triangle, sir. No guys, this is not triangle, this is delta. I'm trying to denote that it means change. Okay, so if there is any change in accounting policy, we all know AS5 says retrospective effect. So what you should do, now your opening inventory is there, no, this 2,16,000, this is actually cost minus 10%. Sir, what is the meaning of that? That means if your cost is 100, they would have subtracted 10%, which is 10 rupees, and they would have valued it 90. So this 2,16,000 represents 90. So you have to find out how much represents 100. So 2,16,000 into 100 by 90, you will get the answer as 2,40,000. So this is the 100% of cost, which earlier you had reduced 10%, that is 24,000, and valued it at 2,16,000. Now you want to go back to cost. So what you have to do, in the last year, you have to go and increase your inventory. You cannot show the inventory at 2,16,000. That inventory should be increased to 2,40,000. Sir, but where is inventory in the balance sheet, sir? Our ICSR has not given it separately. It is included as a part of other current assets. Okay, so inside this 11,10,000 only, that 2,16,000 is there. Now this we have to increase by 24,000. So our revised other current assets will be not 11,10,000, 11,34,000. Okay. And then once you increase your inventory, last year closing inventory, if you increase, profits also will increase. That profit increase will go and increase your reserves. Especially under reserves, you have to increase your P&L, because profit would have increased. So you have to increase your P&L. Earlier it was 2,40,000. Now it will increase by 24,000. So your revised P&L will be 2,64,000. This is what should be taken for the purpose of cash flow statement. Okay, so remember there is a change in accounting policy with respect to inventory valuation that needs to be given a retrospective effect. So opening stock, which is last year's closing stock, I should bring it back to cost. So increase my inventory. Once I increase last year's closing stock, that will increase my last year's P&L also. So to go and increase P&L personal account under reserves. Okay, now let's start the cash flow. Your cash flow's starting point will be P&L closing balance minus P&L opening balance. So what will happen is P&L closing balance is 3,40,000, yeah, and P&L opening balance, take the revised amount 2,64,000. So 3,40,000 minus 2,64,000 will be 36 plus 40, 76,000 will be your starting point. This is profit after tax and after appropriation. That is your starting point. This is after appropriation. So whatever appropriations are there, those appropriations should be removed. Your first appropriation is, if you see, general reserve. General reserve, your opening balance is 6 lakhs, closing balance is 7,60,000. That means this year you have transferred from P&L to general reserve. So because of this, P&L would have been debited. So this is a non-cash item which needs to be reversed. So that needs to be added. So first this is added. Sir, is there any other appropriation? Sir, there is dividend, sir. But remember, what needs to be added here is dividend declared, not dividend paid. Sir, how will I know what is dividend declared, what is dividend paid? Wait. Opening balance of dividend payable is 1,20,000 and closing balance became 0. Did they tell you in the question anywhere how much dividend got declared? No, there is no other information at all. Okay, remember, for preference share capital also, ICA always assumes that it is included as a part of this dividend. Don't take separate dividend for preference share capital also. They will tempt you by giving this 10%, but they will never take in the answer. You will also think, why is preference dividend not taken? Because ICA assumes that it is already included inside this dividend. Now opening balance of dividend payable is 1,20,000, closing balance is 0. That means during the current year, since we don't have any other information relating to dividend declared, we will take this 1,20,000 as dividend paid. Dividend paid is 1,20,000 and dividend declared in this year is 0. There is nothing. So there is no dividend declared. Nothing will be adjusted as a part of appropriations. So we removed appropriations, and now we have to remove whatever is the tax expense that is debited to P&L. Sir, how will I know how much is the tax expense, sir? Listen, sir. They have given you provision for tax. They have given you opening balance, closing balance. Open provision for tax, ledger account. This is a liability. Brought down 3,60,000. Carry down 3,40,000. Now generally what happen here, tax paid will come, here tax expense will come, because tax expense journal entry, we have discussed this several times in the class. Tax expense account debit to provision for tax. Here tax expense will come, here tax paid will come. Generally in certain questions what will happen, one of these two will be given, you will find out the other one as balancing figure. Sir, but now in question both are not there. What I should do, sir? If both are not given in the question, listen to me carefully. If both are not given in the question, assume that opening balance is paid. Sorry, excuse my handwriting. 1 minute. If no other information on tax paid or tax expense is given, our assumption will be opening balance will be taken as tax paid and closing balance will be taken as tax expense that will go to P&L. So that means in your P&L, this is the amount of tax expense which is there, which needs to be removed because we want to bring profit before tax. So that 3,40,000 tax expense which is debited in P&L, that should be added. Finally, if you do this, you will get profit before tax and before appropriations. Next, we have to find all the non-cash items which are debited in P&L that should be removed. Sir, what non-cash items are there, sir? First one, very, very simple one. Depreciation. Depreciation. Add back this because this will be debited. Sir, is there any other non-cash item? Yes. Loss on sale. We had two loss on sale. One is loss on sale, one is loss on written off. Here, there was a loss on sale of 20,000 and write off there was a loss of 16,000. Both of these are non-cash items which would have been debited to P&L. We have to remove them, so we have to add them back. Okay, and then, sir, what else we have non-cash items? We have profit on sale which would have been credited to P&L. So to remove that, we have to subtract. We have to subtract. Sir, will there be any other non-cash items? Yes, there will be. Let's find out. Loss on sale we have taken, loss on write-off we have taken, depreciation we have taken, profit on sale we have taken. Okay, I think those are the non-cash items. So we have eliminated non-cash items. Step 1, we have eliminated appropriations and tax. Step 2, we have eliminated non-cash items. Step 3, now we will eliminate all income and expenses relating to investing and financing activities. Sir, what all we have for investing and financing activity? First thing, for financing activity, we have premium on redemption of 6,000 plus 6,000, 12,000. Both of these would have been debited to P&L. So both of them should be added and removed in your cash flow. And then, sir, is there any other income or expense relating to financing activity or investing activities, sir? We have interest. We have interest on debentures, 9% interest. And you remember they told that redemption happened at the year end. So even for that redeemed debentures, you have to pay interest. So not only for this 2,80,000, even for the 1,20,000 that got redeemed. So totally for 4 lakhs, we have to pay interest at 9%, 36,000. Please read the question properly. They have clearly mentioned that debentures were redeemed at the year end. So whatever debentures got redeemed, even for those debentures, we have to pay interest. So this total 36,000 of interest which would have been debited as expense to P&L, that should be added back because it relates to financing activity. It is not relating to operating activity. If you do all this, you will get operating profit before working capital changes. Our next idea is to do working capital changes. Let us go to current assets. In current assets, will you take cash and cash equivalents? Daivame, will you take cash and cash equivalents? No, it should not be taken. Will you take other current assets? Because no other information is given, we'll assume it relates to operations. So here 11,50,000 is the closing balance, 11,34,000 is the opening balance. So add this opening balance 11,34,000, subtract 11,50,000, which is a net subtraction of 16,000. That is what they would have done here, net subtraction of 16,000. Next, let us go to current liabilities. Do we have anything in current liabilities? Yes, in current liabilities we have. Will you take provision for tax? I told you clearly, see in the format, provision for tax should not be considered. Then other current liabilities also, please go and see the breakup. Breakup, if you see, we have dividend payable. This relates to financing activity. This will not be considered. Since current liabilities, there is no other breakup given. We will assume it as relating to operations. This will be considered. Opening balance is 4,80,000. Closing balance is 5,20,000. Add closing balance, subtract opening balance. So it will be a net addition of 40,000, which you should do as a part of working capital changes. Okay. So once you do, you will get cash generated from operations before tax. And from this you have to subtract tax paid. Sir, how will I know how much is tax paid, sir? We have already prepared provision for tax account, in which I told you, in the absence of any other information, opening balance will be considered as tax paid. So this 3,60,000 will be considered as tax paid, which will be subtracted, and then you have successfully got the cash flow from operations. Okay, investing, financing, very easy, we can finish quickly. Now PP, if you remember in PP ledger account, we found out a balance figure of 8,56,000. Since it is an outflow, take it as negative. And then we sold one PP and got 1 lakh, it is an inflow, take it in positive. Then investments also to the extent of 1,20,000. If you remember, we prepared this investments ledger account, and found out that sale proceeds is 1,20,000. So that is also a cash inflow which needs to be removed. Sorry, that's also cash inflow. Sorry, it needs to be added. Okay. So if you do all this, you will get net cash flow from investing activities. And last one is financing activities. Let us see what and all will come in financing activities from the question. First, equity share capital, opening balance 12 lakhs, closing balance 16 lakhs. That means during the year you have issued shares to the extent of 4 lakhs, which is an inflow. So you will take it as plus. And then preference share capital you have redeemed. So 1,20,000 including premium redemption, 1,26,000 will be outflow for preference share capital redemption. Same way you have also redeemed the debentures. So for this also 1,26,000 will be outflow on redemption, including premium on redemption. And then whatever dividend you have paid of 1,20,000, that also will be a financing cash outflow which should be subtracted. So if you see, they have taken issue of shares, premium redemption of preference shares, redemption of debentures, dividend paid, and whatever interest paid on debentures also is a part of your financing activity. Net 8,000 is the cash outflow from financing activities. If you add all three, you will get net increase or decrease, which is 0. All these three are getting cancelled out. 6,36,000 plus 8, 6,44,000 negative, plus 6,44,000 positive. So net it is 0. Net it is 0. And then to that add opening balance of 10,000, you will perfectly get the closing balance of 10,000. This is how we have to prepare. Remember, in operating activities, step 1, remove appropriations. Step 2, add back tax expense. Step 3, any non-cash items that are there, if it is debited to P&L, add it. If it is credited to P&L, subtract it. And then any other expenses and incomes which relate to investing activities and financing activities, those also should be removed. Then you will get operating profit before working capital changes. Then do current assets and current liabilities, working capital changes. Please once go through in my notes that I have given what should not be considered in that working capital changes. If you are very thorough with that, you can easily tally this cash flow statement. And this is a book back question. Okay, book back question. This question I mainly selected for this inventory adjustment, which is a very interesting adjustment. Okay, it's not like a normal question. So mainly this is why I wanted to discuss this question. Let us go to the first question. Here we will be asked to prepare cash flow statement under direct method. So for our operating activities, we should use direct method. Sir, how direct method, sir? How will I know what needs to be done in direct method, sir? Let us just once quickly go through the format. Okay. In direct method, what you should do, first take cash sales. Obviously, cash sales is from operating activities, guys. This direct, indirect distinction is only for operating activities. Take cash sales. Take whatever is received from your customers and your bills receivable. This sometimes will be given to you directly in the question, or you have to prepare debtors ledger account and bills receivable ledger account and find out. And then take any other operating income that is received like trade commission, royalty, that also should be added. Cash purchases, it is an outflow, it should be subtracted. Whatever cash you have paid to trade payables and bills payable, this you can find out by preparing creditors ledger account and bills payable ledger account. Open that ledger account, find out cash paid, that also should be subtracted. And any other operating expense you have paid like salary, wages, professional charges, royalty, legal charges, all these are operating expenses. Those also should be subtracted. You will get cash flow from operations before tax. We have not yet taken tax. Before tax and extraordinary items, subtract tax paid. No sir, I have refund of tax. It is an inflow. Add that. Then you will get cash flow after tax. Then any extraordinary items you have paid, that should be subtracted. Any extraordinary incomes that you have received, that should be added. Finally, you will get cash flow from operations under direct method. Is this clear, everybody? So this is the format for direct method. Let us see that question. Okay. Prepare cash flow for Gamma Limited for the year ending 31st March 2021 from the following information. Sales for the year is 135. Out of that, 60% is cash sales. So 135 into 60%. Let me get a calculator. So 81 is cash sales, which is obviously a cash inflow. So that will be first itself taken in your cash flow statement. Remaining 40%, which is 54, this is credit sales. Sir, credit sales also should I take? No, that is not cash item. What you should do, credit sales is given to you. They have given you debtors opening balance, closing balance. What you should do, open debtors ledger account. Opening balance 45. Closing balance 50. And how much credit sales? 54. So 2 sales 54. Is there any other information? Purchases, admin expenses, dividend, investment, nothing else. So balance what we get is cash received. 45 plus 54 is 99. 99 minus 50. I hope my math is correct. 45 plus 54 minus 50. So 49 lakhs is what you have received from your debtors that will be taken. So using credit sales information and using debtors opening and closing balance information, find out what is your cash received. That is also an inflow that will be taken. Okay. Next, purchases for the year amounted to 55 crores, out of which credit purchase was 80%. That means in 55, 80%, which is 44, is credit purchases. Balance 11 is only cash purchases. So this 11 cash purchase is an obvious cash item. It is a cash outflow. So take that directly. Sir, credit purchase also I will subtract. No, credit purchase you should not subtract directly. They have given to you creditors opening balance, closing balance. So again what you have to do, open creditors ledger account. Opening balance by balance brought down 21, closing balance 23. Credit purchases will be by purchases of 44. So 21 plus 44, 65. 65 minus 23, which is 42. That will be the cash paid to your creditors, which needs to be subtracted. Okay, let us see the next one. Administrative and selling expenses amounted to 18 crores and salary paid amounted to 22 crores. So this 18 and 22 crores, both of these are operating cash outflows. Sir, but they are calling it as expense. No sir, they are not calling it as payment. No sir, if there is no other information, we will take expense itself as payment. So subtract both this 18 crores and 22 crores as operating expenses. The company redeemed 20 crores debentures at a premium of 10%. That means 20 plus 10% premium 2, they would have totally redeemed it for 22 crores. Debenture holders were issued equity shares out for this 22 crores which they had to settle. 15 crores they issued in the form of equity shares. And the balance 7 crores only was paid in cash. So this 7 crores that was paid in cash will come as a part of financing cash outflow. And whatever 1.5 crores debenture interest you paid, that also will come as a part of financing cash outflow. If you see under financing activities 7, 1.5. Okay. Dividend paid during the year 11.7. This also will come as a part of financing cash flow. Investment costing 12 crores were sold at a profit of 2.4 crores. So total sale value will be 12 plus 2.4, 14.4 crores. This is a cash inflow which will come under investing activities. So if you see, this is coming as a part of investing. Next. 8 crores was paid towards income tax during the year. This will be a part of your operating activities. So in operating activities, this 8 crores will be subtracted. Then a new plant costing 21 crores was purchased in part exchange of an old plant. The book value of the old plant was 12 crores, but the vendor took over the old plant at a value of 10 crores. The balance was paid in cash. CE. You purchased a new plant whose cost was 21 crores. Now you gave him an old plant. For that old plant, that guy is telling, I will take a value of only 10 crores. That means balance 11 crores. You have to pay in cash. So this is the cash paid for purchase of machinery, which will come as a part of investing activities. We're almost done. Okay, so these are all the adjustments, and then now you know what is your investing activity, what is your operating activity, which is coming to 29 after all this addition subtraction. Your investing activity is coming to 3.4, your financing activity is coming to minus 20.2. So net it is 29 plus 3.4, 32.4 minus 20.2, it will be 12.2. To that add opening balance. Sir, where is opening balance given, sir? Here it's given, sir. 6. Add to that opening balance, you will get perfectly the closing balance. Your answer will tally. So this is an illustration on direct method. Sorry. This is an illustration on direct method. Okay, so ensure you practice one direct method question, one indirect method question as well. Last one question, which is actually there in your module 1. These two questions are there in your module 3. Last question, module 1, an interesting question. With this we can close cash flow statement revision. This is interesting, please listen to this. Z Limited has foreign cash flow during the reporting period. It has held a deposit in a bank in France. The balance as at the beginning of the year and at the end of the year were 1 lakh euros and 1,05,000 euros. So this Z Limited sir has a bank account in France, and he is holding their money in euros. Opening balance was 1 lakh euros and closing balance was 1,05,000 euros. Okay, so that means 5,000 euros this year this guy has received, sir. Yes. The exchange rate at the beginning of the year is 82 and the exchange rate at the end of the year is 85. The increase in the deposit balance of 5,000 is on account of interest received on this deposit. So whatever deposit we had, we received interest on that. The deposit was reported at 82 lakhs. Sir, how 82 lakhs, sir? 1 lakh and the exchange rate at the beginning was 82. So they would have converted it as 82 lakhs. Sorry, they would have converted it as 82 lakhs and they would have shown in the balance sheet as at the beginning. And in the closing balance, they are telling it is 89 lakh 25. Sir, how this came, sir? Your closing balance 1,05,000. Your closing exchange rate is how much? 85. So 1,05,000 into 85. It is 89 lakh 25,000. Okay, this is your closing balance. You are required to show how these transactions would be present in cash flow statement. Now listen to this carefully. See, actually what happened, this guy had the opening balance in INR of 82 lakhs and this year he received 5,000 euros of interest on the last day. That means this would have got converted at 85, closing exchange rate of 4,25,000. Now this will increase my bank balance. So my bank balance should have been only 86 lakh 25. But when I convert my entire closing balance at the closing exchange rate, I have 1,05,000 euros into 85. It comes as 89 lakh 25,000. My ledger balance is only 86. But if I calculate, my closing balance should be 89 lakh 25. Sir, first of all, why are you using closing rate, sir? Where is it given, sir? Boss, AS11 says this cash balance is a monetary item. If you remember, for monetary items, we should use year-end exchange rate and convert that. So this 1,05,000 into 85, 89 lakh 25,000 will be the closing balance of this deposit. Sir, there is an increase of 3 lakhs, sir. That 3 lakhs is your forex gain. If you remember, in AS11 we would have learnt forex gain, which will go to P&L. So in your P&L, you will have this forex gain of 3 lakhs and you will also have this interest income of 4 lakh 25. So assume there is nothing else, your profit will be 7 lakh 25, which will be your starting point, for preparing cash flow statement, Okay, now let us see how we will prepare cash flow statement in this case. Okay, listen, let me prepare a cash flow statement and show you. Profit was 7 lakh 25,000, because 4 lakh 25,000 interest and 3 lakhs is forex gain. Now in indirect method, in this question, is there any information on appropriations? Nothing. Is there any information on tax? Nothing. So assume nothing, all those are not there. But we have to remove non-cash items. Yes, sir, we have to remove non-cash items. Is there any non-cash item in this? In this profit, we have two things. One is interest received. This we have received. Obviously, this is a cash item. But the remaining 3 lakhs forex gain, this is neither cash inflow nor cash outflow. This has come because of exchange rate fluctuations. You have not received any cash, you have not paid any cash. So this is not a cash flow, this is a non-cash item. Remember always, all your forex gain or loss or non-cash items which needs to be removed. So less forex gain. Sir, why are you subtracting, sir? Boss, this would have been credited in P&L, so to remove that we have to subtract. So my net increase in cash and cash equivalents would have been 4 lakh 25. To this, if I add opening balance of 82 lakhs, my answer will only be 86 lakh 25. But in balance sheet, my cash and cash equivalents will come at 89 lakh 25. So these both are not matching. How to match this? If you see, the difference is 3 lakhs. That 3 lakhs difference is nothing but your exchange gain. So what you should do, below this you should show it as that exchange gain. You should show it as a reconciling item. Sir, how should I show that, sir? Listen. You have got your closing balance as 86 lakh 25 in this cash flow statement. Add forex gain 3 lakhs. So then your closing balance will be 89 lakh 25, which will perfectly match with your balance sheet cash flow. Remember, first, while calculating cash flow from operating activities, this exchange gain is a non-cash item. It needs to be removed. But if you remove that, finally, when you are presenting the closing balance in cash flow statement, it will not match with balance sheet. So again, you have to add and show that separately as a reconciling item. Sir, above you are subtracting, below you are adding. For that, you need not do anything. No, sir, no. Because we cannot show this as a part of cash flow statement, because this is not cash inflow, cash outflow. Remember, in cash flow statement only cash inflows and cash outflows should come. That is why we remove all the non-cash items. in case of this 3 lakhs, where there is cash inflow, where there is cash outflow. So that is why we will remove it first, and then below, once we finish all the investing, operating and financing activities, we will again add this exchange gain and ensure that the balance matches. Shall we read what ICA is telling? In preparing the cash flow statement, the exchange difference of 3 lakhs should be deducted from the net profit before tax since it is a non-cash item. However, in order to reconcile the opening balance of cash and cash equivalents with closing balance, this exchange difference of 3 lakhs should be added to the opening balance. You should show that as a separate note. If you see here, it is not matching for me 86 lakh 25. So below in a separate note, I will say this 86 lakh 25 plus forex gain of 3 lakhs. If I add, I can match with that 89 lakh 25, which is shown in the balance sheet. Cash flows from transaction of foreign currency shall be recorded in Z Limited's reporting currency by applying to the foreign currency amount the exchange rate between the reporting currency and the foreign currency at the date of the cash flow. Basically, what is telling? All the foreign currency cash flows should be converted into INR using the exchange rate on the date of cash flow. So the crux of this question is this exchange gain of 3 lakhs. Please just go through once this question. See, ICA has not tested, but this type of question, only one question is there. That too, this is there in your module 1, page number 4.37, if my memory is right. Okay, it will be there in page number 4.37. So ensure you go through that once. Okay, so what the crux of this question is, the exchange gain that is there in profit is a non-cash item. First, that should be sitting very strongly in your mind. Sir, why are you telling it's a non-cash item? Because there is no cash inflow, there is no cash outflow. Since it is a non-cash item, first, while preparing cash flow under operating activity, this non-cash item should be removed. Sir, but if I remove that, my closing balance will not match. Then separately show this as a reconciling item and match it with the closing balance. Hope you are very clear with this. Please, I will upload both these notes as well as questions for practice as a link to your YouTube video. Ensure you first revise once the format very well, revise once operating, investing, financing very well, formats very well, and ensure you definitely practice these questions. If you are very logically clear in the format and you have practiced 2 or 3 questions and you are very strong in that, you should be definitely be able to answer any question in the exam. Okay, thank you so much. We'll meet again in the next video, which will be on buyback. Okay, thank you so much. Okay. Hi guys, welcome to the next video on revision of buyback. We'll be revising a chapter called buyback. In my view, quite simple, the most simplest one in the 3rd module, okay, compared to all the giant chapters like amalgamation, branch, consolidation, cash flow. This is a very small and acute chapter, so we can actually finish this quickly. So even during revision, ensure you have revised journal entries properly. Then I will show you 2 sums. Ensure you have practiced those 2 sums. That will cover almost all the concepts. All the concepts will get covered through that. So this is not a chapter which you need to spend a lot of time. It is a very simple one. Be strong in the journal entries that needs to be passed at the time of buyback, and also there are 3 tests: your share outstanding test, resources test, and debt equity test. Ensure that you are strong in that also. Once you are very thorough in these 2 things, automatically this chapter will be a cakewalk. Let us get started. Let us first revise the journal entries. As you all know, buyback of equity share capital means redemption of equity share capital, where after buyback your equity share capital reduces. What is the journal entry that we should pass at the time of buyback? Your equity share capital reduces, so equity share capital account debit with face value of the shares that you have repurchased or bought back. And if you pay any premium, that premium on buyback, the premium component should be debited to a separate account called as premium on buyback. And to equity share buyback, this is a dummy temporary account opened before you make payment. And then to make payment, equity share buyback account debit to bank account. So first, the face value should be debited to equity share capital, then debit premium account, and then credit a dummy or separate account called as equity share buyback, and then next entry itself will be equity share buyback account debit to bank account. Sir, I want to pass as a single entry, sir. Unnecessarily ICA is complicating, sir. Here itself I will do equity share capital account debit, premium on buyback account debit to bank account I will do, sir. Why should I pass these two journal entries? Don't do like that, because most of the questions this is how they are passing. Better you also pass as two separate journal entries. Let's not lose marks because of these silly reasons. Okay. Next, whatever premium on buyback is there, to the extent your securities premium reserve is available, you can adjust it against your securities premium reserve. Anything extra, you can adjust it against your free reserves, which is your general reserve, P&L, whatever reserves are available for distribution as dividend. Remember, in free reserves, you will not include revaluation reserve. You will also not include statutory reserve. These two will not be included as a part of free reserves. And one more point also, clearly remember, for the purpose of buyback chapter under Companies Act, for the purpose of sections relating to buyback, securities premium reserve is also considered as a free reserve. Open your law book and check. Okay, so for the purpose of buyback, securities premium reserve will be considered as a free reserve. And then at the time of buyback, our Companies Act says either you have to raise fresh capital equal to whatever amount you have bought back, or you have to create CRR, because basically Companies Act wants, before buyback and after buyback, Companies Act wants the capital to remain same. So they are telling, to the extent you are buying back, to the extent of the face value of the shares that you are buying back, do one of these two things for me. Either raise fresh capital by issuing new shares, or you create CRR. Do any one. The CRR can be created out of free reserves, which is either securities premium or other free reserves like general reserve, P&L, and this CRR can be used only for one purpose, which is issue of bonus shares. Okay, so these are the journal entries that you have to be strong at the time of which will be passed at the time of buyback. And there are some other journal entries which you should also be knowing. Okay, along with buyback journal entries, you should also know journal entry for sale of investment. I hope everybody will know, when you sell investment, investment decreases, so it will be credited. Bank balance increases, so you will receive money, it will be debited. If there is loss on sale, debit P&L. If there is profit on sale, credit P&L. Daivame, only one of these things will come, not both. Because when you sell, either there will be profit or there will be loss. Both of them will not come. If there is profit, put it as to P&L. If there is loss, put it as P&L account debit. This is the first journal entry which you should know, how to pass journal entry at the time of sale of investments. Next, you should know journal entries relating to redemption of preference share capital also. Sir, that is there only in foundation syllabus. No, sir. Why should we know how to pass journal entry for preference share capital redemption, sir? Because in one illustration, IC has asked you to pass journal entry for equity share buyback also, preference share redemption also. So there's a high chance they may test in the exam also. So better to be careful. We will know even the journal entries for preference share capital. So like equity share capital, same entries like equity share capital. Only thing that you should change is, instead of equity, write preference. If you see preference share capital account debit, face value should be debited. Whatever premium you pay, you will call it as premium payable on redemption, the premium component. And to preference shareholders, then preference shareholders account debit to bank account. This is a due entry and this is the payment entry. And then this premium payable on redemption, first you can adjust it against securities premium to the extent it is available. Any extra amount you can take it to free reserves. And then finally here also we should create CRR. So free reserves account debit to CRR we have to create to the extent of nominal value or face value of the preference shares that you have redeemed. Same requirements like equity share buyback is applicable even for preference share capital reduction. So first we learned how to pass journal entries for equity share buyback. Then we revised what is the journal entry for sale of investments. Then we revised the journal entries for preference share capital redemption. Two more, we will be done with this. We need to know journal entries for own debentures also, and we need to know journal entries for ESOP also. Okay. Journal entry when you purchase own debentures will be own debentures account debit to bank. And once when these own debentures are cancelled against your actual debenture liability, your liability also reduces, your asset which is your own debenture also reduces. So when your asset is reducing, own debenture credit, and liability is reducing, so debenture account debit. And if there is any profit, this will be called as profit on cancellation. Remember, this profit on cancellation should be taken to capital reserve. Remember this carefully. This profit on cancellation should be taken to capital reserve. I have mentioned that in the notes as well. Okay, last one, ESOP. ESOP, during the vesting period, we have discussed the concepts multiple times in the class relating to ESOP, once in fundamentals and once while revising buyback. So during the vesting period, you have to pass the journal entry employee compensation expense to equity share option outstanding. This will be passed during vesting period. Remember that. And then once the vesting period is over and when the shares are actually issued to the employees will pay the exercise price. So bank balance will increase, bank account debit, we will issue shares to them, share capital will increase, so credit share capital with face value, and whatever is extra over face value, that is premium, which will be credited to securities premium reserve account. And this equity share option outstanding which you created will now get debited at the time of issue of shares and will get reversed. These are the journal entries for ESOP. Ensure you are thorough with this also. During the vesting period, you will pass the entry employee compensation expense account debit to equity share option outstanding. And once after the vesting period, when you are actually issuing shares, the journal entry will be bank account debit, which is the exercise price that you will receive from the employees, equity share option outstanding account debit to equity share capital to securities premium reserve to equity share capital. We have to take only face value. Okay, so ensure you are thorough with equity share buyback journal entries, investment sale of investment journal entries, preference share capital redemption journal entries, own debentures journal entries, and also ESOP journal entries. You have to be thorough. Okay, shall we see one sum and then we'll go to those three tests. Let us take our ICA books. Illustration 4. Guys, he would have given a lot of law in this chapter. Please go through that law in your law exam. No need to go through that in accounts exam. Yes, illustration 4. I think this only has perfect. This is a very comprehensive question. Okay. Extra Limited, a non-listed company. Remember, in this entire chapter, they'll ask us questions only on non-listed company, because listed company buyback is governed by SEBI rules, which is not there in our syllabus. Furnishes you with the following balance sheet as on 31st March 20x1. So we have share capital. Let us see what is there in share capital. We have equity share capital and preference share capital. Okay, 100 plus 20, 120. Okay. Then we have reserves and surplus. Let us see what is there in reserves and surplus. We have a capital reserve, we have a revenue reserve, which is these revenue reserves are free reserves. And then we have securities premium. This securities premium is also free reserve only for the purpose of buyback. Remember, for no other purpose you should treat this securities premium as free reserve, only for the purpose of buyback. Tomorrow again in dividend chapter, sir, you are telling securities premium is free reserve. No sir. So can I give dividend out of this securities premium reserve, sir? No sir. Only for the purpose of buyback chapter, the securities premium reserve is a free reserve. Keep that point very strong in your mind. And then we have long-term borrowings. Kya hai is long-term borrowings? What is there in this long-term borrowings? We have debentures. Okay. Then we have trade payables, PPE, non-current investments, and cash and cash equivalents. Let us see what they're telling in the adjustments. The company redeemed preference shares at a premium of 10%. So first we have to pass journal entries for redemption of preference shares. Okay, let us pass that. 20 lakhs is the nominal value. I hope this entire question is in lakhs. Yes, perfect. 20 lakhs is the nominal value. For this they will add 10% premium. So 22 lakhs they will pay. So the journal entry will be preference share capital account debit with the face value 20 lakhs. Premium on redemption 2 lakhs to preference shareholders 22. Then preference shareholders account debit to bank account 22. Pass these two separate entries, due entry, payment entry. Then this premium on redemption will get adjusted against our free reserves. Okay, here ICA has done a mistake. Okay, so what mistake they have done is, in the journal entry they have debited revenue reserves, but when you see when they have prepared the notes to accounts, actually this is a mistake they did in the latest book in May 25. In the last May 25 book it was perfect, but here they made a mistake. So what is the mistake is, if you see in the journal entry they debited revenue reserves, but while preparing this balance sheet notes to accounts, that premium on redemption got adjusted against securities premium. Okay, so what should I do, sir? Now which is correct, sir? You can use securities premium itself. This revenue reserves is wrong, because when securities premium reserve is there, use that. Nah, why do you want to use your revenue reserves? Securities premium is only restricted only for 5 purposes as per section 52. So when you can use securities premium, why do you want to waste your revenue reserves? So ensure that you use your securities premium. So the entry should be securities premium reserve account debit to premium on redemption. We should actually pass one more journal entry, but ICA would have passed that one more journal entry in the end. Sir, what is that one more journal entry? We have to create CRR. Okay, how much is the nominal value of the preference shares that we are redeeming? 20 crores. So to the extent of the 20 crores, using our revenue reserves, we have to create CRR. ICA would have passed that entry in the end. Remember, for buyback and also preference share redemption, 4 set of entries should come. First, due entry. Next, payment entry. Next, entry for adjusting this premium against securities premium. Hey, premium against securities premium. No, this is premium on redemption. So this premium on redemption should be adjusted against securities premium, and then you have to pass one entry for CRR. It also bought back 3 lakh equity shares of 10 each at 30 per share. So 10 rupees face value, they are paying 30. So 20 is premium. The payment for the above was made out of huge bank balance. Very good. So 3 lakh into 30. So totally they are paying how much? 90 lakhs they are going to pay. In that 30 lakhs will be face value. 60 lakhs will be premium. So totally they will pay 90 lakhs. Shall we see what will be the journal entries for this? Equity share capital account debit face value. Premium payable on buyback 60. To equity share buyback due entry 90 lakhs. Equity share buyback account debit to bank, payment entry 90 lakhs. Then this premium on buyback should be adjusted against securities premium. So then securities premium account debit to premium payable on buyback 60. So premium also got adjusted. Sir, what about CRR entry? Sir, I told you CRR entry, what ICA would have done is, both for preference shares and equity shares, they have combined and passed one entry in the end for CRR. We will see that there. Next. Included in its investment were investments in own debentures costing rupees 2 lakhs. Face value of the debentures is 2.2 lakhs. These debentures were cancelled on 1st April 20x1. So what is telling us? Inside this non-current investments of 120 lakhs, there is 2 lakhs worth own debentures. Okay, which now you have to adjust it against debenture liability and cancel it. So what will be the journal entry, sir? One side my own debentures will reduce, another side my debenture liability also will reduce. So the journal entry, if you see, will be debentures account debit, because my liability is reducing and your debentures will reduce to the extent of face value. To that extent it got cancelled. So face value is 2.2. So debenture account debit 2.2 lakhs. To investments, because your own debenture will reduce 2 lakhs and remaining 20 lakhs. Basically what you have done, 2.2 lakhs worth the face value debentures, you have paid just 2 lakhs and cancelled it. So remaining 20,000 is a profit. This profit should be taken to capital reserve. Here also our ICA has committed a mistake in printing. So profit on cancellation of own debentures account debit to, they have passed it as revenue reserve. No, this should be capital reserve. So how are you saying? See, again, here they have put revenue reserve. In notes to accounts, if you see, they have added this 20,000 to capital reserve. So they intended to be capital reserve, but while printing, they made a mistake of revenue reserve. So corrected. Above also there was a printing error. Here also there is a printing error. So this is the entry for own debentures. Next, last one. The company had 1 lakh equity stock options outstanding on the above mentioned date to the employees at 20 rupees when the market price was 30. That means this is the exercise price and the market price is this one. Okay. This was included under current liabilities. On 1st April 20x1, employees exercise their options for 50,000. So what happens is, for 50,000 shares at 20 rupees each, they will pay us 10 lakhs. This 10 rupees difference between market price and exercise price of 10 rupees, we would have already passed entries during the vesting period. 10 rupees into 1 lakh, 10 lakhs. This 10 lakhs will be sitting in equity share options outstanding account. That equity share options outstanding account is there inside this, trade payables. Actually, this is not a right disclosure, but they have given in the question. We'll go with that. That 10 lakhs, which is that 1 lakh into 10, this 10 lakhs, which will be there inside equity share options outstanding account, and in the balance sheet, that account is sitting inside trade payables. Sir, okay, sir, now what entry we should pass? Now all my employees will give me 10 lakhs. Bank account debit 10 lakhs. This is the amount that I would have received for 50,000. Now for this 50,000 options, in my equity share options account, 10 rupees per options will be sitting. That now can be reversed because now we are issuing shares. Equity share options account, 50,000 into 10, 5 lakhs. To equity share capital, only face value will go. 50,000 shares ka face value 10 rupees, 5 lakhs. Remaining will go to securities premium reserve, 10 lakhs. This is the entry that you should pass. To the extent of the shares that employees have exercised, this difference between market price and exercise price, which is 10 rupees for 1 lakh options, 10 lakhs, that equity share options outstanding balance of 10 lakhs will be sitting inside trade payables. Now for 50,000 shares they have exercised, so we have to reverse that. So now we will debit that 5 lakhs and reverse it. Remaining 50,000 will still remain in that equity share options outstanding account. In future, when you are issuing shares for that also will get reversed. If you see bank account debit 10 lakhs, they are calling it as employee stock option outstanding. I called it as equity share option outstanding. Both are correct. 5 lakhs to equity share capital, 5 lakhs face value. To securities premium, the premium component will go. And finally, we should also pass CRR entry. CRR should be created to the extent of face value of the equity shares and preference shares. So if you see, preference shares face value that we redeemed is 20. Equity shares face value that we redeemed is 30. So 20 plus 30, total face value that we have redeemed is 50 lakhs. So for this we have to create CRR, debit revenue reserves and credit capital redemption reserve. You would have passed all the journal entries, and then you have to prepare balance sheet. So how should I prepare this balance sheet? It's simple. There is the question format. Copy the same format. Hey, but don't copy the numbers. Copy the same format. Take the numbers as per question. See in each journal entry whether you have debited or credited that account. Based on the nature of account, add or subtract. You will get what should be the value in the balance sheet. Final answer balance sheet. And then, like what he has prepared notes to accounts, you also prepare those notes to accounts. Clearly show what should be added, what should be subtracted. With that, you will be able to crack the closing answer balance sheet also. Okay, so ensure for balance sheet preparation, you take assistance from the question itself. Clear this one, and also make the changes based on journal entries. So this is one very comprehensive sum where buyback is covered, redemption of preference shares is covered, own debentures is covered, ESOP is covered, everything gets covered here. So this is a comprehensive sum. Ensure you definitely revise this sum once before the exam. one more sum I want to discuss relating to those three tests which was asked in the latest Jan 26 attempt paper. Yes, this one. Question number 3. This was a buyback question asked in our latest Jan 26 examination. A simple question, but IC has created just one confusion because of their differing interpretations. Let us see what it is. Following is a balance sheet of P Limited. Balance sheet of P Limited as on 31st March 2025. Share capital is given. We'll see the notes. Then we have reserves and surplus. We have long-term borrowings, short-term borrowings, current maturities of long-term debt. So what is this current maturity of long-term debt? See, assume in 2025, I took 15 lakhs loan. Okay. And this loan will be repaid in 3 installments. That means 5 lakhs I will pay in 2026. Another 5 lakhs I will pay in 2027. Another 5 lakhs I will pay in 2028. Now if you see, from this 31st March 25 balance sheet, within next 12 months, I will pay this 5 lakhs. This 5 lakhs which I am going to pay in next 12 months, this should come under current liabilities under the head short-term borrowings. Remaining 10 lakhs which I am going to pay after 12 months from 31st March 25, that 10 lakhs I should show it under long-term borrowings because I will pay it after 12 months. I will pay it after 12 months, sir. Basically, out of total long-term borrowings, whatever you're going to pay within next 12 months, that will come under short-term borrowings, current maturity of long-term debt. Whatever you're going to pay after 12 months, that will come under long-term borrowings. Next we have trade payables. Okay, in assets we have PPE, inventory, trade receivables, cash and cash equivalents. Notes to accounts, authorized share capital, equity share capital, we have 150 lakh shares at 10 rupees, 1500 lakhs. In reserves we have capital reserve, securities premium reserve. Remember, capital reserve is not a free reserve. Securities premium is a free reserve for the purpose of buyback chapter. Revaluation reserve is not a free reserve. General reserve is a free reserve. Surplus balance sheet statement of P&L, this is nothing but our P&L personal account. This is a free reserve. Okay, ensure you know this clearly. Capital reserve is not a free reserve. Revaluation reserve is not a free reserve. Statutory reserves, investment allowance reserve, or some other reserve created as per requirements of a law, that is also not a free reserve. You cannot use it however you want. And then in long-term borrowings, we have debentures, and there's also unsecured loan. Okay. Now, what is the company trying to do? Considering the large surplus funds available at the disposal of the company, it decides to buy back 30 lakh equity shares. The prevailing market price of the company shares is 16 rupees per share. And in order to induce the existing shareholders to offer their share for buyback, it was decided to offer a price of 25% over the market. That means market price is 16. They want to pay 25% extra, because if you also pay market price, why will they come to you? They'll go and sell in the market. So they are to make you buy, to make you give the shares back. They are telling I will pay 25% extra, which means 16 plus 25% of 16, which is 4. So 16 plus 4, buyback price will be 20 per share. This will be the buyback price. Buyback of shares is duly authorized by its articles and necessary resolution has been passed by the company towards this. Comment with your calculation whether buyback of shares by the company is within the provisions of Companies Act. If yes, pass necessary journal entries. Now we have to check whether they can buy this 30 lakh shares or not. For that we have to do 3 tests: shares outstanding test, resources test, and debt equity test. Let us see what those tests say. First test, shares outstanding test. Totally, how many shares are in this company? 150 lakh shares. Sir, how did you get that, sir? It is there in the question in notes to accounts. 150 lakh shares. Now, our Companies Act says out of the total number of shares that are outstanding, maximum we can repurchase or buy back only 25%. So 115 to 25%, as per this test, we can buy back only 37.5. Remember this 25% is. This is the maximum number of shares that we can buy back as per shares outstanding test, which is the first test and the simplest test of all. Next test, second test is resources test. In resources test, what we have to do? First, take our paid up capital, which is 1500. Then take all the free reserves. If you see in the notes to account itself, we marked those free reserves. What and all are our free reserves? 300, 1800, 2100 plus 150, 2250. So paid up capital 1500, free reserves 2000, 2250. So total paid up capital plus free reserves is 3750. This is the total resources. Now what Companies Act is telling? Apply 25% on this, which is, let me just get the number, 3750 lakhs into 25%. So that comes to 937.5. Now what Companies Act says is, maximum on account of buyback, you can pay only this much. You cannot pay to the shareholders more than 937.5 lakhs. That means, how many shares I can buy back? 937.5 divided by 20 rupees per share is my buyback price. So totally I can buy back 46.875 lakh shares. This is the number of shares that can be bought back as per resources test. So we finished shares outstanding test. We finished resources test. Last test is debt equity test. This is the last test and the most interesting test. Okay, what we should do is, in this test, let me explain this. Please listen to this carefully. This is an interesting test. This test says that after buyback, my debt by equity should not be more than 2:1. It should not go beyond 2:1. Maximum it can be at 2:1. Now here, what is debt, sir? Okay. As per ICI, debt is long-term borrowings plus short-term borrowings. You should take both long-term as well as short-term borrowings. So in all long-term borrowings, we have 3450. Remember, both secured borrowings also should be taken, unsecured borrowings also should be taken. Both you should take. So 3450 long-term borrowings. Short-term borrowings is 1980. Don't take trade payables. Debt means borrowings. Take both long-term as well as short-term. 3450 plus 1980. So total debt is 5430. Now my maximum debt equity should be 2:1. That means if my debt is 5430, after buyback, how much should be my equity? ஏன்னா இது வந்து maximum எவ்வளவு வரைக்கும் தான் வர முடியும்? 2:1 வரைக்கும் தான் வர முடியும். So x should be equal to 5430 by 2, which is, so post buyback, my paid up capital plus free reserves should not go below 2715. If it goes below 2715, then my debt equity will become more than 2:1. Companies Act requirement will not be satisfied. So first you should ensure that after buyback, your paid up share capital plus free reserves is not going below 2715. For that, first we should know how much is it now, sir. Now your equity is, equity means here paid up capital plus free reserves only should be taken. 1500 paid up share capital plus free reserves 300, 1800, 2100 plus 150, 2250. So total 3750. Before buyback, so this is the equity that we want after buyback and before buyback we have 3750. That means in buyback how much equity we can use? Before we have 3750, after we need to ensure we have 2715. That means we can only use 3750 minus 2715. Only 1035 can be used for this buyback. You should not use more than that. If you use more than that, it will go below 2715. Debt equity ratio will go beyond 2:1. Company's act requirement will not be satisfied. So maximum for the purpose of buyback, we should use 1035. Here only one master stroke or one point that you should remember very clearly. This 1035, inside this 1035 itself, we should finish buyback also. We should finish CRR creation also. Ensure that. This point you have to remember. 1035 buyback பண்ணனும் CRR creation முடிக்கணும். அப்போ நான் என்னன்னா, let us assume that I am going to buy back X number of shares. So for buyback I am going to pay per share 20 rupees. So I will spend totally 20x, and then I should create CRR to the extent of face value. Face value is 10 rupees. So total CRR I should create will be 10x. So I should use this total only out of this 1035. I cannot exceed 1035. Then how much will be my x? 1035 divided by 30. 34.5 lakhs is what I can buy back using this debt equity test. Okay, please remember this point. First, take what is the existing debt as per balance sheet, which is both long-term borrowings as well as short-term borrowings. Total comes to 5430. Our debt equity ratio should not go beyond 2:1. So if our debt equity ratio is 2:1, I should have an equity of 2715 after buyback. Before buyback I have an equity of 3750. So that means I can maximum use 1035. Out of this 1035 only I should both go with buyback as well as I should create CRR. Let us assume that the number of shares is X. So per each share I will pay 20. So it will be 20x, and I should create a CRR to the extent of face value of shares. So this is 10x. So 20x plus 10x, this 30x should be equal to 1035. So x will be equal to 34.5 lakhs. So as per debt equity test, maximum number of shares that I can buy back is 34.5 lakhs. So if you see, this is the number of shares that can be bought back under debt equity test. Now if you see under first test, test 1, which is shares outstanding test, test 1 I was able to buy back 37.5. Using test 1 I can buy back 37.5. Using test 2 we calculate resource test, 46.875 can be bought back. Using test 3, which is debt equity test, I can buy back 34.5. Now which I can buy back, sir? In all these 3 tests, whichever is the lowest, that is the maximum number of shares that you can buy back. Remember, calculate the number of shares that you can buy back as per each test. Of all the 3, take the lowest, not the highest. Take the lowest. That is the maximum number of shares that you can buy back. Here the lowest is 34.5. So as per Companies Act, maximum number of shares that you can buy back is only 34.5. But in question, how many shares they want to buy back? They want to buy back only 30 lakhs. So they are within the maximum number of shares that is allowed. So they can go ahead with this buyback. Then you can pass journal entries for that buyback, which is what we already discussed. I hope I am very clear here. So ensure you are clear with journal entries for equity share capital buyback, preference share capital redemption, own debentures and ESOP. And then practice illustration 4 well, and then you have to be thorough with these 3 tests: share outstanding test, resources test, debt equity test. Go through those tests from the notes I have given there clearly, and then also practice this Jan 26 sum. You should be done with this buyback chapter. Okay, so I hope this is a very small cute chapter which you can easily finish faster. So ensure you make best use of this. They have asked in Jan 26 for 7 marks a very simple question. So a very scoring chapter. If it is asked, you can definitely score good marks. Okay. Thank you so much. I'll come back with another revision video next time. Thank you all.